Right now, the most valuable companies on earth are racing to sell you their stock. More money, bigger names, and higher valuations than anything the stock market has ever seen before. To some people, this is the opportunity of a lifetime. The greatest technology boom in history is finally opening its doors. For decades, the best companies stayed private, growing in the dark, out of reach for ordinary investors. But now at last the doors are being thrown open and you get the chance to own a piece of the businesses that could define the next 100 years. To others, this is not a celebration. It is a trap. And by the end of this video, I think you will see exactly why. Because in the stock market, an open door is never just a favor. Every trade needs a counterparty. Every buyer needs a seller. So if you are trying to buy stock, someone has to be willing to sell it to you. Which means before you buy what they are selling, there is one simple question worth sitting with. Why are they selling? In an initial public offering, the people on the other side of the trade are not random. They are the founders who built these companies. The early employees who gave years of their lives. The venture capitalists who funded them when they were nothing. Nobody on earth understands these businesses better than they do. They have seen numbers you and I will never get access to. And they have looked at the most exciting companies of our lifetime, the ones everyone is desperate to own. And they made a decision. They would rather have your cash than their own shares. This is what an IPO actually is. Strip away the headlines and the celebration, and it is a trade with massive information asymmetry. The sellers are the most informed people in the room. Which means the buyer by definition is the least informed person in the room. And right now that buyer is you. So here is the question the people behind this wave are quietly counting on you not to ask. If these really are the most valuable, most important companies in the world, and the future is as bright as everyone keeps promising, then why are the people who know them best in such a hurry to sell them to you? There is an answer. It is a pattern that has repeated throughout the history of markets. It has appeared right before nearly every major financial bubble has popped. And most people have no idea it is sitting right in front of them. I call it the dine and dash. In poker, a tell is a small unconscious signal that reveals what someone actually believes regardless of what they are saying out loud. Markets have tells too. They do not come from headlines or earnings calls. They come from watching what the most informed people actually do with their own money. The average investor sells when they get scared, when the news turns or the chart drops, when everyone around them is already running for the door. But the professionals do the exact opposite. As Benjamin Graham, the father of value investing and Warren Buffett's mentor said, the intelligent investor is a realist who sells to optimists and buys from pessimists. They sell when everything looks perfect. When the story is loudest, the optimism is highest, and there is a line of buyers out the door begging to get in. Because that is the moment you can get the most money for what you are selling. Which is exactly what the IPO data shows. When markets are booming, companies rush to go public and sell shares. When markets turn south, those IPOs disappear almost immediately. That is the tell. That is the top being sold to you. And we have seen this pattern before. Go back to June of 2007. Wall Street was booming. Markets were running hot. The two co-founders of Blackstone, one of the largest alternative asset managers in the world, decided it was time to cash in. They took Blackstone public. Between them, the two founders walked away with about $2.6 billion in cash. Then a little over a year later, the global financial crisis hit, markets crashed, and Blackstone stock plummeted roughly 90%. It is almost as if the soon-to-be world's largest alternative asset manager had a view on where asset prices were heading. Or go back further to the dot-com era. In the years leading up to the crash, the number of companies going public exploded. In 1999, the year before the bubble popped, the concentration hit a record. Of every company that went public that year, approximately 51% came from a single sector. Technology. Then the year after all of them listed, after the insiders got their money and retail thought they were buying a piece of the digital future, the bubble popped. Over the next 2.5 years, the Nasdaq crashed more than 75%. An estimated $5 trillion in market value simply evaporated. It took 15 years for the Nasdaq to recover. And a study by the Kauffman Foundation found that 10 years after going public, only 29% of the emerging growth companies that listed between 1996 and 2000 were still standing as independent public companies. The rest were gone. The thing people thought they were buying no longer existed. In 2021, the same tale appeared wearing a different costume. The SPAC, Special Purpose Acquisition Companies, blank check shells that raised money from investors first, listed on exchanges, and then went shopping for a real business to merge with. The appeal was simple. A SPAC let a private company reach the public market without the scrutiny of a normal IPO review process. So the money rushed in. In 2021, alone 613 SPACs went public and raised more than $160 billion. For a full year, these blank check shells made up more than half of every new company hitting the U.S. market. The story ended exactly as you would expect. Companies that completed a SPAC merger in 2021 lost 67% of their value on average. Those that merged in 2022 lost 59%. And SPAC activity collapsed from 613 in 2021 to just 86 in 2022 the moment the market turned. Insiders sold into the boom. Then the boom ended. That is the dine and dash. So what about AI right now? Why are the most valuable companies in the world, fierce rivals who agree on almost nothing, all racing to sell you stock at the exact same moment? It comes down to two numbers. The first is the spending. This year, the largest technology companies on Earth are on track to spend approximately $725 billion building out artificial intelligence infrastructure. That is up roughly 77% from the year before. The largest and fastest infrastructure build-out in history. To put that number in context, if you spent $1 million every single day starting from the day of the birth of Jesus, through the fall of Rome, through the Middle Ages, the Renaissance, both world wars, and every single day up until right now, you still would not have spent what big tech alone plans to spend on AI in 2026. That breaks down to roughly $2 billion a day. $83 million an hour. About $23,000 every single second. The second number is what all that spending is actually earning back. The research firm Exponential View produced the first real bottom-up estimate of the entire AI economy. Over the past 12 months, all of it combined generated an estimated $110 billion in revenue. Not profit. Revenue. Put another way, the entire AI economy earned back an amount equal to roughly 15% of what big tech alone plans to spend this year. By any investment standard, that is a deeply unfavorable ratio. And before you assume it must be better for the businesses actually using AI rather than building it, the data says otherwise. Deloitte surveyed more than 3,000 business and IT leaders across 24 countries and found that 74% of organizations want AI to grow their revenue, but only 20% have actually seen it happen. Researchers at MIT studied hundreds of real corporate AI rollouts and found that 95% of them produced zero measurable return. $725 billion going in. $110 billion coming back out. 95% of corporate deployments producing nothing measurable. That gap between what is being spent and what is being earned is what the market appears to have decided does not exist. The valuations have priced these companies as if every bet pays off perfectly and on schedule. Take OpenAI. Still private, but the financials leaked and they filed confidentially to go public, so the picture is clear. Last year, OpenAI brought in around $13 billion in revenue. The company nearly tripled that in losses. In 2025, OpenAI reported a net loss of approximately $38.5 billion. By their own internal estimates, they expect to burn well over $100 billion between now and 2029. And their last funding round valued the company at $852 billion, more than 65 times their revenue. That is not a bet on fundamentals. That is a bet on blind optimism about a future that has not arrived and may not arrive on the timeline the valuation assumes. Which brings us to perhaps the most honest thing ever said out loud by someone at the center of a financial crisis. In the summer of 2007, months before the global financial system nearly collapsed, Charles Prince, then the CEO of Citigroup, was asked about the bank's continued exposure to risky lending even as credit markets looked increasingly stretched. His answer became one of the most quoted lines in the history of finance. He said, "When the music stops in terms of liquidity, things will be complicated, but as long as the music is playing you have got to get up and dance." We are still dancing. He was not saying he believed the party would last. He was saying the opposite. He knew it would not. But as long as money was flowing, he was going to keep dancing because the second the music stopped, whoever was still on the floor would be the one who got hurt. He understood that beneath all the dancing, it was really a giant game of hot potato. And the only thing that mattered was passing the potato on to someone else before the music cut out. Which is exactly what you are watching right now. The potato is stock in AI companies priced for perfection. The players are founders and early investors passing it to the next eager buyer. Every one of them knows someone eventually gets left holding it. None of them know exactly when the passing stops. So the only rational move is to hand it off now, into the biggest, most enthusiastic crowd of buyers they can possibly find. The United States stock market. The people running these companies are not foolish. They can see the gap between prices and fundamentals. They see that valuations have sprinted miles ahead of what the technology is currently producing. They know the market has priced these companies for a future where every bet pays off simultaneously and perfectly. But they are also in the middle of an AI arms race that requires enormous capital. And an appetite for a long bet with uncertain returns can only last for so long before it has to be converted into something real. Whoever sells first gets to sell into the hungry crowd. I cannot tell you when this ends. Nobody can tell you when any bubble pops with any reliability. It might be a month. It might be a year. It might be longer. Anyone who looks into a camera and tells you they know the date is lying. But you do not need the date. You just need to be able to read the room. The tell is right in front of you. The most informed people in the world, the ones who built these companies and know every number inside them, looked at the most exciting technology in a generation and decided they would rather have your cash than their own shares. That is the tell. That is the pattern. And the history of markets is very clear about what tends to follow it. You do not need to know the exact moment the music stops to know one thing with certainty. You do not want to be the last one on the dance floor when it does.